Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about holding strong opinions loosely. So have you ever had an opinion or a belief, or a prediction about investment markets that was subsequently proven to be incorrect and that you were surprised the fact that you were actually wrong? And I don't mean that in a really arrogant way, but I mean that sometimes we have opinions about direction of markets or behaviours or outcomes, and we start to become very firm with our opinions, and that can create problems sometimes, particularly with investing. And that's why I like the saying, hold strong opinions loosely. Have conviction with respect to your opinions, but certainly be open to the fact that they might not be correct. It's my view that a humble mindset is really the best way of, firstly, avoided being blindsided by unexpected investment risk. So not seeing the risk is the problem. And two, making sure you spot all your investment opportunities. And that's the topic of today's podcast. So I was reading Robert Glazer's Friday Forward blog, which he writes every week, believe it or not, as the name suggests, on a Friday. And he made a reference to a book called Mistakes Were Made, but not by Me, by two authors that are psychologists. And they talked about the situation where cult leaders would predict that the world was going to end on a specific date and told everyone to prepare for that date. But when the day passed without obviously a fiery inferno, the world didn't actually end. You would expect these cult leaders to have lost all credibility. Instead, the exact opposite happened. Leaders simply just declared their prediction was wrong and declared a new date, and followers doubled down and began preparing for the next apocalypse, and which sort of defies belief. But I guess we've all seen these cults being talked about in the media and seen these things happen. And there's even situations where the cults have engaged in mass suicide because they were told that their human bodies wouldn't take them to the next life, and so forth, etc., etc. But seemingly bizarre and irrational behaviour. And so the authors sort of shone a light on why did this exist, and they suggested that it was just too painful for the cult followers to admit they'd fallen for a fraudulent prophecy. And it was just easier to avoid interrogating their own judgment and instead dig a deeper hole of delusion for themselves. And I thought it was a really interesting story that had some application towards investing as well. And certainly there's been times, or there's segments of the investment industry and property market that I think exhibit some of these characteristics. And particularly of late, there's been a bit of media about the change in expectations for property prices. That in around May this year, a lot of people, in fact, the vast majority of people were thinking, the property market was going to crash, and prices would fall somewhere between 10 and 30%. But over the last couple of weeks, there's been a lot of movement, and the general market consensus now is no real change. And so the property bears have disappeared. But it's really interesting to note that there has been some commentators, certainly over the last 18 years since I started Pro Solution, that have been perpetually negative about the Australian property market. It's always overvalued. It's always just around the corner for a correction. And the two people are Martin North and Dr. Steve Keen. Martin North runs a company called Digital Financial Analytics, but used to be a consultant for a larger international company. And Steve Keen's an economist that's now working in London, but used to work for a few Australian universities. And I remember actually Steve Keen being interviewed on 60 Minutes on TV in 2008, telling all Australians to sell their property, that property was going to crash. In fact, they even showed him walking through his apartment that he was living in at the time, that he also sold, and he was absolutely convinced. And I remember watching it thinking, I don't believe this is going to happen, but wow, he's 100% convinced. Almost started doubting myself. Anyway, he predicted that prices would drop by 40% between 08 and 10. They didn't. They dropped somewhere between 5 and 10%, I think, from memory. It certainly wasn't even close. In fact, an interest rate strategist had a bet with him from Macquarie, had a bet with him, and the loser had to climb Mount Kosciuszko, and so he did that. He had to do that as the loser of the bet. But certainly he was wrong, but he also doubled down after he was wrong and said, yeah, I was wrong, but it'll happen by 2025. Well, we're at 2020 now. We've got low interest rates, loosening lending standards, lots of government stimulus going on. Of course, we've had COVID, but certainly it looks like his prediction is going to be wrong yet again, but somewhat reminiscent of the cult followers that are predicting the end of the world. These perpetually negative views that without any room for possibility that they could be wrong, ignoring all the evidence, the fact that they've been wrong over the last 20 years, and in fact the property market has delivered, at least investment grade property has delivered pretty compelling returns over that time. These situations or these people kind of lack credibility. So there's always going to be these people out there that hold a view, and I think the risk is, or the issue or the problem that they're dealing with is that they hold the view so strongly that they can't see that there could be another side of the coin. And I guess another example I've seen is some financial advisors, they have a viewpoint or have a methodology that they believe in and will defend it staunchly. I think people that defend a position so strongly, perhaps it's a sign that they're not holding strong opinions loosely, and in that situation they won't see the risks. If an advisor believes that active funds management or a particular approach adopted by one rules-based investment manager, for example, which is I'm referencing a situation that I'm familiar with. So even if they have such a strong belief, they just won't see things change, markets change, or risks occur, or they'll be blind to all these sorts of things. Things in life are rarely black and white. There's always some level of nuance. So that's why I love that saying, hold strong opinions loosely. Again, have conviction in your investment strategy, which is, should be supported by sound evidence and evidence-based strategies and methodologies and so forth. But at the same time, leave room for the possibility that you could be wrong. Leave room for the possibility that not every investment you make will actually work out exactly how you'd hoped. And this humble mindset will greatly reduce your investment risk, because you won't be, or at least there's very little chance of you being blindsided by unexpected risk. But also it ensure that you spot opportunities and you keep kind of testing yourself. The other thing to be really aware of is confirmation bias as well. Confirmation bias is a tendency to look for or only take notice of information or evidence that supports our own beliefs. And when it comes to investing, confirmation bias is really dangerous. So for me, if I believe in an evidence-based, low-cost, diversified index way of investing, then really the only information that I should consume is information that is written by people that also believe the same things as me. And that will create a heavy amount of confirmation bias. Well, that's not what I do. And in fact, I'm about to join a presentation in a couple of hours from a active fund manager in the global funds management space. It's really important to make sure that you consume almost equal levels of information. information from sources from people that you believe or that align with your beliefs, I should say. And then information that is contrary to your beliefs. And you keep testing what you believe in terms of where the property market's going to go, how to invest in shares, who is the right financial advisor to appoint, or who should you be dealing with, should you in fact get advice, all these sorts of things. Just be careful about what information you're consuming and make sure it's a broad array of views, and that way you avoid the temptation to really fall into that confirmation bias, adopt your view and hold it too strongly. I do that with economists and portfolio managers that I meet with from time to time. What I will do in those situations is argue the point for the alternate view that I have. So, for example, if I think the US tech sector is overvalued, and I do, I will go into that meeting making an argument that technology is in fact going to play a massive role in economics and business over the next few decades, and that's what's reflecting in its current valuation is how big a portion it will play. And so I'll argue for the affirmative that in fact technology is a great investment. That'll invite me to be the devil's advocate in my own mind and sort of almost debate my own beliefs and test my own beliefs internally. And then also people that have broad and deep experience, the economists and the portfolio managers that I'm meeting with that spend a lot of time thinking deeply about these issues. It'll give them an opportunity to argue against me, and then that'll just confirm my own beliefs. Or in fact argue for me and present other considerations that I hadn't otherwise thought. Now, they might not be so prepared to do that and disagree with me in almost all situations. So the fact that then I start with an alternate view is make sure that they're really going to tell me what they think it is, rather than necessarily just blindly agree with me. So it's a really good opportunity then to sit back and think about what are some of the beliefs or strongly held views that you have, and could you be wrong? Over the last 20 years of meeting with different investors and so forth, hundreds, thousands of investors, there's a few common beliefs that I come across. Investing in shares is risky, that's one. That all financial advisors are greedy and shouldn't be trusted. And we can completely understand why people hold those views given what's come out in the media and the Royal Commission. And in fact, I don't argue with the fact that on the whole, financial advisors have done an absolutely terrible job at representing their clients' best interests. Another one is that property is overvalued and cannot generate double-digit returns in the future. I come across people that think, they wouldn't go anywhere near property. Now, I'm not saying you need to test or change those views, but just realise that holding or adopting very strong views and not allowing the possibility that you could be wrong will either create or expose you to investment risks that wouldn't otherwise be acceptable, or will cost you in terms of opportunity costs. You miss opportunities. So it's a really good thing just to sit down and have a think about and reflect on what views that you hold and whether you're holding them too strongly. Okay, that's it for me this week. The podcast is doing really well, so I'd like to thank everyone for listening in. And if you do enjoy it, please do share it. Please like it on iTunes or wherever you listen to your podcast, so we can spread the word. But until next week, bye for now.